Today, we are going to be talking about 3 high-quality, recession-proof stocks that are perfect for investors to consider during these times. The very first pick is no other than Procter and Gamble. Procter and Gamble is one of the world's largest consumer staples companies, which has been in business since 1837, and it sells over 60 products in more than 180 countries. You notice here, Procter & Gamble is traded with ticker symbol PG and has a dividend safety score of 99, which is a very safe dividend pair. It currently has a dividend yield of 2.52%. Last time that Procter & Gamble increased its dividend goes back to April of 2022, where they increased it by 5%. From a volatility perspective, Procter & Gamble is considered to be a very low volatility stock with a beta score of only 0.43. Procter & Gamble's strong portfolio of brands include 21 products which generate over $1 billion in annual sales, and these strong brands give it industry-leading market share in products that consumers buy no matter what the economy is doing. As long as Procter & Gamble continues to invest in research and development to stay on top of their evolving consumer preferences and invest in the right advertising and distribution channels, its business should remain a force for many years to come. In fact, if you look at their dividend history in terms of their key metrics, currently Procter & Gamble has a payout ratio of 61, and its forward payout ratio for its dividend is 62%, both of which indicate a low payout ratio, giving them a ton of room to continue to grow and pay their dividend for years to come. In fact, their dividend history is just incredible. Over half a century of dividend payment and dividend growth history. In fact, Procter & Gamble has been paying its dividend for the past 65 years uninterrupted. And in all of those years, they've increased their dividend years after year. This includes the recessions that the company has kind of gone through that storm. In fact, during the recession of 2007 to 2009, their sales was only down by about 8.9%. And on top of that, although the stock went down during the recession years, in between their peak to the trough of about decline of 36%, it definitely still beat that of the S&P 500's performance of negative 55%. Let us take a look at their payment details for their dividends. Procter & Gamble does pay its dividend quarterly, and it's paid in the months of February, May, August, and November. And currently, they have an annual payout of $3.65. In terms of the timeliness for buying or considering the stock to add to your portfolio, it is worthwhile mentioning that their dividend yield is currently about in line with their own 5-year average. In fact, their current dividend yield of 2.52% is just below their 5-year average of 2.58%. As for their forward price to earnings ratio, which is at 24.5, it is slightly over their 5-year average of 23.3. For the most part, it is in line with their own 5-year average of forward price to earnings ratio, suggesting that the stock appears to be reasonably valued at this time. As for their stock price in the past 1 year, the last trading price of $145.07 is hovering slightly closer to their 52-week low price, which was at $132.36. It is worthwhile mentioning that at the highest price that the stock had hit in the past 1 year was at $164.21. Let us take a look at the number of additional financial metrics, such as the earnings per share and sales for the business. As for earnings per share, ideally, you would like to see this adjusted earnings to see continuously and gradually growing over time. For the most part, that is the case. If you take a step back, there is that upward trend that we are seeing, of course, with some decline over the years of 2016 and 2015 and 16 and 17. But since then, the company has picked up on its earnings per share, with the last 12 months showing $5.73 in EPS, and the next 12 months estimated to have earnings per share of $5.92, which would be the highest that they have had in the past 10 years. As for their total sales, we are seeing a little bit of that decline for, again, continuously during the years of 2015, 16, and 17. But since then, they've reversed that trend. And in the last 12 months, they are showing $79.6 billion in total sales. Although it's less than that of 2012 or 2013, the upward trend is promising. As for outstanding shares, ideally, we are interested in a business that keeps buying back its own shares, gives more value to investors. And this is the case for Procter and Gamble. We are seeing in the last 12 months, they are having 2.55 billion outstanding shares, which is less than that of the past 10 years, all of the past 10 years, with the only exception being in 2019, where they have 2.54 billion outstanding shares. Lastly, if you look at the return on equity, which is an important measure of how many dollars of profit a company earns for every dollar that shareholders have invested in the firm, we are seeing the last 12 months return on equity is at well over 15%. In fact, it's at 32%. The 15% is that threshold that we would like to see for consumer staples businesses such as Procter and Gamble. So that's a very positive sign for us to see. All of that to say, Procter and Gamble remains a very strong pick for dividend investors who are looking for a perfect option as a recession-proof business. Our next pick is Coca-Cola, another consumer staples business with ticker symbol KO. It has a dividend yield of 2.82% and shows to have a safe dividend at this time. It last increased its dividend back in February of 2022, where they increased it by 4.8%. Coca-Cola is another very low volatility stock with a beta of 0.46 and a market cap of $270 billion, making it a mega cap size business. It was last traded for the price of $62.50. Coca-Cola is the world's largest beverage seller, marketing over 3,900 products under 500 brands in more than 200 countries and territories through 24 million retail markets. The company owns 21 brands that generate over 1 billion in sales. Looking at the dividend payout ratio for Coca-Cola, currently they are showing a payout ratio of 70% and their forward payout ratio is at 71%, which is slightly edging higher for consumer staples. But that is not too much of our concern given how strong of a dividend payer Coca-Cola has been historically. In fact, they have been paying their dividend for the past 59 years. And in all of those years, they've increased their dividend year after year. If we look at their performance during the recession years of 2007 to 2009, their sales was down by only 4.8%. And their stock between their peak price to their trough was only down by 31%. Although it's negative return, it's definitely better than that of the S&P 500, negative 55%. As for the timeliness for the stock in terms of its price valuation, if we look at their current dividend yield, it is showing to be at 2.82%, which is slightly less than that of their 5-year average at about 12% below that. The 5-year average is at 3.20%. What's more, as for the forward price to earnings ratio, which is at 25.1, it is higher than their 5-year average of 24. All of that suggests that the stock may be overvalued at this time. And if you look at their latest price of $62.50, it is hovering closer to their 52-week high price, which is probably a good option for investors who are interested in another recession-proof stock to possibly consider Coca-Cola as one of the stocks for their watch list. Or if they want to add to their shares of Coca-Cola or pick up these shares, maybe do so in different steps and gradually. Don't necessarily put all your money and buy the stocks at this time. There is a good chance that if we are going to be seeing a recession, the value and the price of the stock would have that pullback, and you could pick up these shares at much more affordable and much more favorable prices. All right, let us take a look at some additional details, such as earnings per share. For the last 12 months, Coca-Cola has shown $2.42 earnings per share, which was the highest in the past 10 years. And the next 12 months is even better. They're expected to have $2.49 in earnings per share. As for their total sales, it was showing some decline between 2016 all the way to 2020, but since then they're gradually recovering. In the last 12 months, they have $40.1 billion in total sales, although it's still way less than that of their 2012 that they had $48 billion in total sales. As for outstanding shares, we are seeing that gradually they've bought back their shares over the past 10 years. That said, in the last 12 months, they have 4.35 billion outstanding shares. Lastly, if you look at the return on equity, which we would like to see that threshold of 15% met, in the last 12 months, they have well surpassed that with 42% return on equity. Lastly, our third and final pick of a recession-proof stock for investors to consider is no other than Johnson & Johnson, with a dividend safety score of 99, making it a very safe dividend payer, and a dividend yield of 2.54%. Johnson & Johnson last increased its dividend back in April of 2022, where they increased it by 6.6%. Johnson & Johnson, available with ticker symbol J&J, is a mega cap business with $469 billion in market capitalization. It was last traded for the price of $178.23, and it is considered to be a very low volatility stock with a beta of only 0.31%, which is way less than the beta of 1. Johnson & Johnson is the largest global medical conglomerate with over 250 subsidiaries operating across more than 60 countries. The firm's three business segment provides Johnson & Johnson with a very diversified mix of revenue, earnings, and cash flow. However, the pharmaceutical division is the largest contributor to Johnson & Johnson's business, accounting for over half of total pre-tax profits. About 75% of the firm's revenue is from number one or number two global market share positions. What's more, over 20% of sales are from new products launched within the past 5 years, highlighting the company's ability to continuously innovate and adapt. As for their dividend payout ratio, we are looking at the ratio of 43% currently and the forward payout ratio of 44%, both of which are considered low for most companies, giving Johnson & Johnson a lot of room to continue to grow its dividend. They have been paying their dividend for over half a century. In fact, Johnson & Johnson has been paying its dividend uninterrupted for the past 59 years, and in all of those years, they increased it year after year. As for their return during their recession years, their business sales was down only by 6.2%. However, the stock was down by 27%. Although it is a negative return, that is way better than the S&P 500's negative 55%. Looking at the timeliness of getting the stock, their dividend yield of 2.54% is very close to that of their own 5-year average of 2.60, within the 3% range. As for their forward price to earnings ratio, which is at 17.5, it is in line with their own 5-year average, slightly over that, which was at 16.6 for the 5-year average. The stock price, however, though, is hovering closer to their 52-week high price, which was recorded at $186.01. The lowest price that the stock hit in the past 1 year was at $155.93. Looking at the earnings per share for Johnson & Johnson in the last 12 months, it had a number of $9.88, which is highest amount in the past 10 years. As for their earnings per share in the next 12 months, it is estimated to be at $10.20. It's positive to see that number growing. As for total sales, they are showing that almost picture perfect, nice upward trend of their sales with the last 12 months at $94.9 billion total sales. And nicely so as well, they are overall buying back their shares with the last 12 months showing 2.67 billion outstanding shares, which is the lowest amount in the past 10 years. As for the return on equity, we are seeing that Johnson & Johnson has well maintained its positive position in terms of return on equity, well above that threshold of 10 to 15% for all the past 10 years, with the only exception being in 2017. For the last 12 months, in fact, their return on equity is at 28%. Well, there you have it, folks. A quick look into 3 high-quality recession-proof stocks that are perfect for dividend investors, especially during the times that we are. Let us know if you have any of these stocks in your portfolio or plan to add them to your watch list. As always, if you enjoyed this video and gained something of value from it, please don't forget to smash that like button and subscribe to our channel. Here on Momentum Finance, we post every week several videos about investing, including investing in dividend stocks, growth stocks, penny stocks. We'll talk about investing in crypto and ways to reach financial freedom. Thank you, and I hope to see you next time.